Sanjeev Prasad, Senior Executive Director and Co-Head at Kotak Institutional Equities, joins in. Good morning, Sanjeev. Good to have you with us. Well, the markets have run up. I mean, no need to repeat that. We were getting fantastic targets from our guests. Once 8,000 was crossed, almost the entire market seemed to be crying out for 9,000 by March. Some people calling for 10,000 by 2015 end. Do you think this rally is terribly intact?
I think the medium-term rally is pretty much intact. I don't think there's much doubt about it. As we see economic reforms being put in place by this government, I assume economic recovery will pick up on the back of that, and so will earnings growth. Having said that, if you look at valuations, they're slightly on the higher side. If you look at the normal historical trading band, which is somewhere about 13 to 16 times on a 12-month forward for the BSE 30 index. So we are already at about somewhere about 16 times now on a forward basis for 12-month forward basis, that is. So now I think it's more of a question of roll forward. So whenever people start discounting maybe 2016 numbers or 2017 numbers in turn, then you will see some movement in the market. But as of now, it looks like 2016 is getting more or less discounted. Maybe another 7-8% upside from where we are before 2016 numbers start getting fully discounted. And then it's a matter of time as to when you want to discount 2017, whether it is end of 2015, whether it is middle of 2016, I don't know. Maybe we'll have to wait and see as to how eager the market is to pull forward earning numbers. But as of now, all I can say is 2016 is looking reasonably discounted, and I think from here on the upside would be somewhat more muted. Maybe 7-8% over the next let's say 9 months before 2016 numbers get fully discounted. But having said that, if this government manages to do or put in place a lot of economic reforms, the view changes accordingly. Then you are looking at a situation where the medium-term growth numbers would be a lot higher. Maybe the cost of capital would be lower, and accordingly you can argue for a higher multiple for the market.
So you would think that we might end 2014 itself not very far from where we are now?
I would think so. In a normal course of events, probably yes. As I said, the key now is what reforms you will see from now to the next budget, let's say. As of now, there's a little bit of a setback based on some of the decisions of the Supreme Court. So the economic recovery which we're looking at, it was somewhat fledgling, I would say. There could be some setback to that if we don't resolve some of these issues in terms of, the power sector, coal block allocation, natural resource issues, all those things if we don't sort out, then it will push back the economic recovery to some extent.
Hi Sanjeev, good morning. So to play for the consolidation in the market, at least in the near term, what would be the changes that you would make to your portfolio?
See, we have been pretty positive on automobiles and private banks since the beginning of the year. So, those have worked out reasonably well. When we continue to do so, we still like the story from medium-term perspective and more the private banks, I would say. Of late, we have been adding more consumption names in our portfolio, starting from the day of the election. In fact, we started adding more consumer staples, which has worked out reasonably well. And again, on the back of our view that economic recovery will pick up as we go forward. So even though the stocks are trading at high multiples, these are good stocks and will participate as economic recovery unfolds. Some of the changes which we have done in terms of reducing the weight are more on the energy side, where I think the story is more or less played out. We were very positive at the beginning of the year in terms of these stocks being good plays on the fiscal reform theme. When we have seen that already taking place, as you know, gas and diesel are more or less now out of the subsidy mechanism, and to some extent the stocks are discounting a big improvement in their earning numbers from lower subsidies going forward. So we have accordingly started reducing the weights on the oil and gas space.
Well, just to complete that argument, Sanjeev, you wouldn't worry about these stocks losing out because global refining margins are falling, and some experts tell us set to fall even further.
Yes, it is a little bit of a concern, I would say, but at this point in time, I guess the focus is more on how the reforms part as far as subsidies and the subsidy sharing mechanism play out. As of now, what has happened is overall subsidy numbers have come down based on lower subsidies as far as diesel is concerned. But we still don't know which way the government will go in terms of reducing the subsidy burden on the oil companies. Presumably, it will reduce the burden oil companies, but we have still not heard anything from the government as yet. So, I think as of now the valuations are still okay for most of the downstream companies. If I look at BPCL, a fair value 770, it is somewhere in the range of around 680, 690 kind of a number. So it's not too bad, I would say. Even if we build in somewhat lower refining margins compared to whatever we have in our models as of now.
Okay. Sanjeev, you spoke about the upside in the markets being limited to 7 to 9% from current levels by at least till the end of the year. What about the downside? What would be the probability of a correction in your eyes, as well as the extent of a correction?
There are two things. One is obviously on the global side, if you see Fed tightening or expectation of Fed tightening picking up once again, which seems to be the case of late, you have started to see some amount of strengthening of the dollar. And if you start seeing some amount of money coming out of the debt markets in India, that is FI debt, that could start putting some amount of pressure. So that could be one, area to watch out in terms of negative news flow. The second one is the converse of what I was talking about in terms of reforms. If you don't see much of progress on reforms, that could be negative, and especially if you see some of the, the court cases which are, judgments are due in the next, let's say, few weeks. If they go completely different versus expectation, let's say, for example, if the Supreme Court decides to ban all coal blocks, including the operational ones, then it's definitely a big negative as far as sentiment is concerned. Maybe the economic impact is limited because the coal mines will probably still continue to operate, whether it is by Coal India or by the private operators before they are reallocated. But I think there's a much bigger impact as far as the investment, I would say, psychology is concerned, because anything you do on a retrospective basis, whether it is taxation changes or whether it is cancellation of coal blocks, resources, etc., that's a big negative. And I think whether it's for domestic or foreign investors, people will take it quite negatively.
Yeah, I
the
guess.
other thing was similarly on this.
No, please go ahead. Sorry.
I was saying the other thing was on the power sector side, where we were hoping for some resolution of the problems in terms of the CRC formula and compulsory tariffs, etc. But now the Supreme Court has put a stay order on the order of the APTEL. That means this option is probably no longer available. I mean, we still don't know which way the Supreme Court will go, but if, assuming the compulsory tariffs are not allowed, then what the hope was that some of these power plants which are in some amount of financial stress, maybe because of compulsory tariffs, their financial situation improves, that also goes away. So then you have to start looking at more longer-term solutions of, price increases by states, whether that will happen or not happen, I don't know. Coal production being ramped up over a period of time, that's not going to happen in the short term. So the power sector problems still remain intact in that case, and which is, I think, a big worry for the banking system, I would say.
Yeah, actually, we were coming to that. One, because we've got a money control query for you. A question Dinesh has written to us from Anand in Gujarat, and he says he bought shares of Central Bank at 118 rupees a share about 3 years back. He wants to know if he should exit the stock. But on a larger basis, where do you see banks? Will they be outperformers, underperformers, market performers over the next 1 year? And which banks?
No, we always had large amount of faith in the private banks compared to the PSU banks. I think there are still a lot of challenges in the banking space. What I was hoping for was some amount of generic and specific solutions for the sectors to solve the problems, particularly the power, steel and telecom sectors. But it doesn't look like that's going to be the case. So I think it's going to be a very long haul over here in terms of fixing the problems of these sectors, which in turn puts pressure on the banking system. And I was coming to the power sector in particular. If you look at SBI's data, the NPLs in the power sector for SBI is only 0.9% of its exposure to the power sector. Whereas if you look at SBI as a whole, it's about 5%. So somehow it seems to me that most of the problems of the power sector still not be recognized. And over the next, let's say, 1 or 2 years, if a lot more power plants are commissioned, and the hope is somewhere we get coal, somehow the power tariffs get realigned upwards, the PPAs get renegotiated. If some of those issues don't get fixed, I think there could be a lot more NPLs in the power sector, and that's where my big worry is, because if you look at between power, road, steel, telecom, that is about 18% of the loans of the banking system, and I don't think we have really addressed the problems, I would say, in the power, telecom and steel sectors. So I would still be quite wary of the potential hits coming in from these three sectors.
Sanjeev, you're one of the best analysts for Reliance Industries, and you've reduced your weightage on RIL by 100 bips. What was the rationale for that? And what's your outlook on the stock now?
We still like the stocks. I think from an absolute basis, there's still money to be made over here. I'm just doing some amount of portfolio reallocation, putting more money in the consumer staple names, and cutting weights in some other areas. So that's the only rationale over here. I think on the gas price issue, there could be some minor disappointment. So I think we should be prepared for that, because whatever little we are hearing in the press seems to suggest that the government is more inclined to look at, I think, still somewhat of a middle-of-the-road solution, which I don't think is the right way to approach this problem. Either we decide that we will control the sector fully, or you decide we'll go the full, the market pricing way, market way. And I think that probably should have been the right approach. We can't have this middle-of-the-road solution where we give $6 to $7 per million BTU, which is neither here nor there in terms of attracting fresh investments in the sector. I don't think at $6 or $7 per million BTU you are going to see a fresh investment. So that doesn't really address the supply issue. And I'm not very sure, what does it mean for longer term resolution as far as the gas supply issue is concerned, or the resolution for the power sector is concerned, many of these power plants which are based on gas. So I am not very sure whether we have achieved anything by taking this middle of the road approach over here.
Okay, well, that's a bunch of talks you've spoken to us about. Sanjeev Prasad, appreciate you joining in and dropping by in our studio. Thank you very much for joining us. Sure.